Okay, so somebody wanted me to break down what I'm doing with the options. We're finna strictly talk about options. That's just one of the ways you could get paid in the market. I use options for income. This isn't long term. This isn't day trading. This is just a consistent way to make income. I normally sell options, but this week I've been buying SPY options. Now you could go to options.ai and you can see everything I'm seeing at this website. And there's another website you could go to called Options Optimizer if you want to find options with the highest premium. If you're selling them, you want to find options with the highest implied volatility. If you're buying them, you want to buy when the implied volatility is low because it'd be cheaper. You want to buy when it's cheaper and sell when it's more expensive. Okay, well, back to Options AI. This is what I do before I buy any options, and this is how I decide what I want to do for the week. Well, one of the things I do. I check to see where the options volume is. I want to see who's buying calls, who's buying puts. Right now, it's about 50-50. 36,000 on the call side, meaning you want the stock to go up, 35,000 on the put side. So that's just for today. And then I check the open interest. This is open positions that could have been made yesterday, the day before. So we still got a lot of people on the put side. We got double the amount of puts, meaning they want the stock to go down still. So a lot of people still have their positions open. They haven't closed the puts, so they still expect it to go down. Then I go to the most active options contract to see what the overall picture looks like. This is pretty much big money and what big money is doing. So when you accumulate all the most active option contracts, if it goes above or at 5,300 before the day is over, they'll make 3 billion collectively. $3 billion. And if it goes below, I think the lowest put is 49.80. Everybody on the short side will split about 2.5 billion. Okay. So I look at that as well. And I round it up. So you got 3 billion to the call to the long side, then you got 2.5 to the short side. That's pretty much damn near 50-50. Then I go look at BART chart and look at the overall picture. I don't really tell people about BART chart no more because they charge now, but they got some good information, but it's not free. Then I go here and look at my levels and see where I should sell puts or buy calls. And if I'm at a demand level where people have bought in the past, then I buy calls if the calls are cheap enough. If I'm at a resistance level, then I will probably buy puts. Or if I already have the stock, I would sell cover calls. I'll get to that later. One reason why I went long yesterday, these are support levels. It's hitting your support. I done got burnt enough times selling at support because I seen this and got scared. So now I see this and I get excited. So we got from this level to this level, all potential profit. Nothing's guaranteed. Potential profit. But I think the odds are in our favor since we're coming off support. And then I look at my probability of success. You can see in percentage terms the likelihood of you winning this trade. So if I'm buying calls, I want to be in the money. So if I look at the prob OTM and it's 65%, that's out of the money. I don't want to be out of the money. I want to be in the money. So an easier way is just look at the delta. The delta shows you the likelihood of you winning this trade, which is 36%. But it changes. It changes every day. I normally like to get something like 40 and up, 50 and up. The lower the probability, the cheaper it is to buy. So if I'm on a demand level and I got a good feeling about it, I'll buy it at 36%. Even though when I bought it, it was around 50, but it went down because the market has been going down since Monday. So I need these to turn around for me today. Because every day you're wrong when you buy a call, you lose money. You lose a little bit of that premium. That's why I like selling calls and puts, because that money that they lose each day, I make. And then I want the probability out of the money to be high like it is today. So I may lose that option, but I got it for so cheap, I'll only be losing $1, which is $100 because you got it times it by 10. Every contract is 100. So I'll be losing $100, but I bought more. I bought the 64 strike that expires on the 19th, which is not looking too good for me. I'm down $100 on that. $100 because I bought 3 contracts. So I'm down 100. Then I bought the 63 strike that expires on the 26th. I'm up on that. And then I bought the another strike price for the 19th. So if I'm wrong about this week, hopefully I'll get money back by next week. Now I'll come back on here on Friday and let you know if I won or if I lost. I'll let you know how much I won or how much I lost, or if I sold early. Because if I come up on the one I'm losing on now, I'm gonna sell that one because every day I'm losing money, more and more money. The closer it gets to expiry, the more money I lose. So if I break even on that one, I'm gonna sell it. The other ones I'll let them ride out because if the market could pump up for me, I'll make some decent money on that. I might make 100% return on that.